I don't study every Asian market. I find it really hard to crack Korea and Japan. I wish I did. I cannot overcome the fact that if I cannot understand the language, I am banking on the fact that the translation is correct.
This year, I will likely increase my cash position. I will likely be performing less transactions. There's more money that has been lost in anticipating market crash than has been made. And because of that, I don't see myself selling positions.
Are you a gundu or guru? The obvious answer for many investors is I want to be the guru. I want to achieve these kind of gains. But as I look at my investment performance for the past 6 years, I have been a gundu maybe 3 to 4 times just to become maybe a guru for 2025.
Welcome back to Chills with TFC. I'm your host, Reggie, aka your Chief Financial Coconut, and this is the start of the year. We are back rolling some new episodes. So I am very excited to be in studio with some friends of the show to talk a little bit about their investment strategy for 2026. And yes, I know the studio looks a bit different because today we are at Commune, a partner of ours. They have very, very nice furnitures. We'll drop the link below, okay? Hopefully got promo code for you. But that aside, 2026 investment strategy is more important. So back on stat, we have Contra Turtle. How was it? How was it after becoming like going viral?
Okay lah, just normal lah. Just still living my
Hey,
life.
walao, you're very counters, yeah, very contra. Yeah. How was it after the episode went out for you?
Oh, I got a lot of DMs, people asking me, and they were a bit inspired by the journey and stuff. Quite a lot of messages after that.
Awesome. Did you all watch the episode? Because in the episode, I kept laughing because I'm interviewing a turtle. So I found it very hard, and I think that is still consistent. I still find it very hard to interview a turtle. But regardless, and we are joined with Dawn, SG Budget Babe, and Chris. For our audience that don't know you, introduce yourself.
Hi everyone, my name is Dawn. You might know me online as SG Budget Babe. I've been in this space for this is 12 years since we're into 2026.
You sure you want to flex time? Because the guy next to you is going to flex a longer
Yeah, it's okay.
time.
And I actually read his blog when I first started, so he should take that credit, right? And I'm also an author of the book Take Back Control of Your Money, where I talk about your money mindset and basics of investing. So please check it out, all the work that I do. But over on my side is Chris, whom I read his blog growing up, and
Thank you very much. My name is Christopher Ng. I'm a blogger and I have a YouTube channel. Both are called Growing Your Tree of Prosperity. I also teach the Early Retirement Masterclass with Dr. Wealth.
Yeah, awesome. How was the episode after you aired?
It seems that the people who watched my previous video is fixated with the way I pronounce the word dividends. Okay?
David.
I have recently corrected myself.
Why
and
did
hopefully
you?
in today's video, I will be using the word dividends.
Okay. Why did you feel compelled to convert to dividend? I texted him in the comment section that was like, dividend, this guy needs to say properly. Then I texted Chris, I was like, our next event will print dividend. It's a t-shirt.
Yeah, I think the problem is that people are fixated with the pronunciation and not the substance of what I'm trying to say.
Exactly.
Right? Which is the problem with many of these videos.
Yeah, exactly. Okay. So you are doing it for the betterment of society.
Yes, for the betterment of the society.
Right? Well, improve society. Okay, great. So I think to kickstart, maybe because all of you have shared different bits on the show, right? But for our audience that maybe first time interacting, new year, new me type of energy, right? Maybe just to lay the ground on like broadly, how do you invest? So share your investment strategy and your ideas, your thesis before we apply it to 2026.
can I introduce Chris first? Because I think he downplays himself all the time. But Chris is actually fully retired or financially independent already. And he actually built a portfolio of dividends that allowed him to retire not just himself, but also provide for his entire family, pay for a law degree, and do a lot of things that I think even normal people struggle to do. And I found that very inspiring. So yeah, you can add on.
All right, so I've generally 2 approaches represented by the course I conduct. The first, the Early Retirement Masterclass, focuses purely on dividends investing, and we are totally locally driven. Now, that also means that for the past 5 years, we've been underperforming and we look like idiots, right? Not so in 2025. We've done much better in 2025. So that is maybe 99% of my portfolio, focused locally, driven by passive income flows. That tiny 1% is the domain of another program that I run known as the All-Weather Portfolio, inspired by Ray Dalio's approach towards investing. And that employs computer code to make investment decisions, right? So that has multiple algorithms. We run a very aggressive trend following algorithm, and then we have a mean reversion algorithm, okay? And that's more technical in nature. So the combination of these two portfolios allow me to have a very broad, very helicopter view of not just what's happening in Singapore, but also around the world.
Okay, so that's Chris. Yes, Dawn.
For myself, I am a undervalued growth investor. So to summarize my approach, I look out for good quality companies with strong fundamentals, and I only buy into them when the prices are low, in the sense that valuations are cheap. So that also means that for many of the good companies that I own, I do end up averaging up. I seldom get the chance to average down. If it does, I'm always very happy. But more often than not, it's about making the hard decision to average up. And I don't do strategies like dollar cost averaging, because I believe that you should be buying at opportune moments. And across my entire investing career, really, if I backtest my own performance and positions, right, the truth is dollar cost averaging into them would not have given me the returns that I did. So as an example, for instance, last year in 2025, the S&P did 16%. Right, 16.7 or 16.8. Okay, let's just round it to 16 or 17%. But my returns on the same instrument was actually 30-something%. And how that was done was because I only acted when the S&P was severely undervalued in 2025, which happened in April. I made just one move, and that one move outperformed everyone who did 12 moves regularly over the year. Now, of course, the trade-off is you do need to recognize when it's undervalued, but I think that's also where the fun and the lifelong learning of investing comes from.
Okay, but just so I push that a little bit, right? Like, that is on the assumption that there will be some sort of a opportunity, right?
There will always be opportunities.
Okay.
It's where you're
From a
looking.
frequency standpoint, you think so? It's every year you'll get such opportunities. Just so
So
we're
the thing
clear.
is that when you invest in stocks or individual counters, there will always be opportunity. It's just where you're looking. Are you looking only in Singapore? Are you looking in the US? Are you looking in Hong Kong, Japan, Korea? I mean, if we were to look at some statistics, last year, the best performing country market was Korea, and then Japan did also exceedingly well. If you had invested in Japan before Warren Buffett did, you would have gotten really good returns. Even if you invest after Warren Buffett, you would have still made decent returns, right? But how many people were even looking at Japan to begin with? And that is just the country index. You have stocks within, let's say, Kospi in South Korea, right? Like SK, what's the name? SK Hynix.
SK Hynix, right?
Yeah, I can never pronounce
Yes.
that company's name. So they did 200% returns in 2025. Yeah, and there is always, you could have always gotten into all these opportunities, but I think the impression that people get is always they're so fixated on the market is so overvalued right now. What should I do? I can't buy. No, there's always opportunity. It's whether or not where are you looking and whether you're doing what it takes to find them.
Fair. Okay. Well, we'll go there later. Yes. And Contra Turtle?
I am quite similar to Dawn.
Okay, that's the end of the story.
No, he's more contrarian than me.
I'm what I call a GARP investor. So similarly, a growth at reasonable price investor. I have a really concentrated portfolio. I focus mainly on my circle of competence, which is largely US technology companies. 100% of my portfolio is growth because I'm still reasonably young. I'm in my 30s. And my main strategy or main way of approaching investments is that I think in terms of two frameworks. The first one is I only move into companies during periods of deep pessimism. So for example, if let's say last year, people had doubts about companies like Meta or companies about Netflix, when bad news hits, I usually wait for bad news to hit and then I make a move. So that's like my signature sort of style of executing. The second thing that I try to think of in terms of managing my portfolio is opportunity cost. So my portfolio is really concentrated and I don't think anyone should follow what I do because I really study my businesses very, very closely. But the reason why it's so concentrated is not really intentional. It's a result of opportunity cost. What do I mean by that? So right now, right, I only have 5 positions. And every time I want to add a new position, let's say a 6 or 7 company, the question I always ask myself is this 6 or 7 company worth me allocating incremental capital over the existing companies that I've already researched? Is there any opportunity cost? And the opportunity cost comes in two factors. One is the growth trajectory and the long-term durability of the company. That's number one. And the second one is valuation. So balancing between these two factors, my 6, 7, or 8 position, they have to satisfy this requirement or opportunity cost over the first 5 positions I already own before I even consider the 6 and 7. And because it's been so difficult, I've been investing for the last 5, 6 years. And I couldn't find any new position to justify the opportunity cost. But I think coming to this year, maybe it might be possible.
Oh,
but yeah.
Actually, what are your 5 tickers? You've said it on your platform, right? Probably.
Yeah, I mean, people who follow me a lot, they will probably know my top 2 positions are Meta, followed by Exxon, not the oil company. That's 2. Then I have Amazon as well, Netflix, as well as Mercado Libre, which after Venezuela, something interesting happened yesterday.
I have a question. So if you're so concentrated in just 5, then what do you do with your cash every month when it comes in? Because it might not be a period of great pessimism for you to add on.
This is a great question. I'm very fortunate because in the last 5 years, there have been opportunities every year, but they don't come very often. And similar to you last year in 2025, the biggest opportunity was definitely in April. Very similar, Liberation Day. So typically, the thing that I normally do is I go for fat pitches. I'm okay waiting with cash. I'm okay if my cash position is high. And I'm okay even with a cash position waiting for a few years while I'm underperforming the market. Because my goal is not to outperform the market in a year, but I try to aim for a long-term CAGR of at least 10 years. So there will be years even when I sit on cash while I'm waiting, I will underperform. So that's something I have to be comfortable with.
Okay. And what do you do with the cash? Just so we get the context.
So going into this year, right, that question is going to be even more pertinent because this year I feel like we can probably branch into the whole question about the whole AI narrative that's going on now because I think that affects a lot of people's investments in the S&P. And since the Max 7 is so predominant in this weighting in the S&P. But going into this year, cash-wise, either it's going to be in really just cash, probably just in IBKR, or maybe in just a high-interest account, or maybe in just FD, or I may consider selling CSPs. It really depends on the situation, like how volatile we get this year.
Yes. And then how do you manage your cash on the side?
For me, the good thing is that every month I am always able to find opportunity. So every month I am usually able to find something. And I set very high standards for myself before I invest into anything, which is every month I always have at least 1 move, if not 2, right? And then of course, like last year, April was just crazy. If you look at my scorecard for last month, I think we were discussing it in our group chat recently, right? My April was like this long, and then the rest of the month was like 1 each or some 2. Yeah, but April was like a whole big bunch because I was adding on to a lot of existing positions as well because they went undervalued. So what I do is I try to ask myself this question before I enter any stock. Do I think I can make at least 20, 25 or 30%? If the answer is no, then I will not buy. Yeah, the only difference is that I cannot predict and I cannot set the time frame. So of course I have to also then say that not every stock hits this in the end because some of them have really just gone down. Some of them might be a temporary down. A lot of things we don't know until only time can tell, right? Like in 2022, I remember Palantir completely broke that record. I bought in at 22 and then I watched it drop to $5 plus. So technically I was just talking, that is like seeing your investment drop 75%. How does that even meet my 20% threshold, right? But fast forward to today, because I did not do anything. In fact, I bought more at $7. So that's what I do, what I call a repair strategy. So because of that, I'm sitting on more than 2,000% returns on Palantir. So yes, that has actually met my threshold.
2,000% after you average your additional capital deployment.
Correct. And the same thing for Alibaba. I think a lot
Alibaba
of people would know.
Great turnaround. Yes.
Alibaba was down, and I also suffered that down for quite some time. Again, it did not hit that threshold. I thought it would when I went in, but then obviously after that, because of the China crackdown, it did not. But fast forward to today, my Alibaba is up by almost 2x. So it does meet my threshold. So the challenge I have is that I don't know when it will hit that level that I expect. But I know in time, and I hope that it does. And in my overall portfolio, this is also a very important lesson for investors who don't understand the concept of portfolio and diversification or allocation. You will have some that may not do very well. and I have some positions that have gone to zero, but the winners more than make up for whatever losses that has ever happened. And this is only something that only time can show you, because I read this lesson when I first started, right? You do read these in books and all, but you don't really understand the gravity of the lesson until you have experienced it yourself. And it took me at least 6 years before I started seeing this happen in my portfolio that I realized, oh, so this is what the lesson was all about.
Okay, but does that hold for dividend?
Well, I don't have all these wonderful traits to talk about to everybody. We did have a very lucky year in 2025 where my portfolio went up about 22% overall. So it's a pretty fantastic year.
For a dividend investor,
Yeah.
that's pretty
Yeah,
good.
that is incredible.
We think we should be humble about it because it has been many years of underperformance, right? Especially if you're heavily weighted with real estate investment trust. So we're coming in with a lot more humility than other investors, and I think that's very important. You have a question on cash flow. My family receives approximately $11,000 to $12,000 in dividends every month. Not counting the rental collections we have from properties in Singapore as well as in Malaysia. We typically spend about 40 to 50% of our incoming cash flow. And then the rest of the money is then redeployed into the markets. And very boring Singapore investments, typically consisting of banks, real estate investment trusts, business trusts, and I'm fiddling around with Singapore depository receipts, which also means more banks from Hong Kong and petrol companies from China.
Actually, why? Why are you fiddling around with SDRs?
I love the concept of SDRs. I'm primarily a very old school CDP investor. So what SDRs allow me to do is
wait. For our audience that may not know about CDP,
Right.
So
But
CDP
explain
is
a bit.
like
It's a very old
5
school.
years ago.
Yeah, the new
People
investors
could
will
still
know
kind of
one.
get it, but
Yeah.
5 years from now, it's like, what is CDP? Just use
so young people
animal
don't know
account.
what CDP is. It is, imagine a bank account. Instead of your funds, you put your stocks inside. Okay? And if you're invested in CDP, you can become an activist. You receive annual reports. You can attend AGMs. So as you build these CDP accounts, and the fact is that sometimes I can't talk about how well my trades have done because I don't know how well they've done. There might be an Alibaba or a Palantir hidden in my portfolio, but I don't know and I don't
you don't
care.
care.
Right? The important thing is from 5 to 6% we receive the sums. The money needs to be spent to support a family, and the rest of it goes back into financial markets. Generally, I will fiddle around with SDRs to increase the amount of diversification so that our aim is not to achieve any alpha or do better than other people. Our aim is to reduce the standard deviation of the portfolio so that over time, it doesn't move as much as possible. It doesn't give me a lot of drama. I can focus in other areas of my life where there's a lot more drama, like the way I pronounce the word dividends.
I follow a few dividend investors other than yourself. And I realized that a lot of them, the Singaporean ones, right, they also invest in Hong Kong stocks.
Yes.
But you acknowledged earlier on that 99% of your portfolio is more local exposure. So how come
Yes.
you never go the Hong Kong route?
I am changing. I am slowly changing into Hong Kong. And Hong Kong, there are fantastic dividend counters. Bank of China, Ping An Insurance. I also have Petrol China, which took a recent hit because of Venezuela. I believe that I will be putting more in this region with the excess dividends, depending on how frugal my family. It turns on whether my children need tuition. So if they don't need tuition, I've got more dividends. That's all.
Okay, so Chris'
Right.
children don't ask for tuition,
Right.
so daddy can put in
Daddy
more
can
money
invest
to
more. Okay, fair.
I mean,
No,
we'll
but-
go to them in the future.
Yeah. But I love the opening, to see every different type of investors, with a different makeup on the strategy, with some sort of in like there's a thesis to why you land on this strategy, and then you have a good grasp of like what's going on, and all that. So all that is good, and we're not this is not financial advice, or we're not professing a certain way of investing and all that. We're just really trying to share our point of view, how are we doing this thing, right? So feel free to comment in the comment section, but just move on from dividend, okay? Like that is so not important. Exactly. I was so annoyed with the comment section because guys, let's talk about the juice, right? What's inside? Okay.
Can I share something also? I think that's a
Sure.
very important takeaway, which you by design have put the three of us together here because we represent very different approaches, yet each has its merits and trade-offs. So I think the problem with most investors or people who are trying to invest for the first time is that they don't know what to follow. So they just try to copy, right? And they don't realize that actually the best thing in investing and the most important thing is that you need to invest in a way that suits you. So like Contra Turtle's approach, I know I cannot do. Yeah, I mean, I know the concept, right? When he was talking, I could totally hear Buffett and Munger's voice, and Templeton also periods of great pessimism. I've learned and studied all these and I've tried those strategies. But I cannot do what he does because it requires so much conviction. It's such a huge exposure. I don't think I can sleep at night. I cannot tahan 25% or 20% exposure to just one position. I am more comfortable with maybe at best 10%, but I can honestly say I have never allocated at any one point 10% of my entire portfolio into just one position. The 10% are like it grew to become 10%.
Yes, it grew to the 10%.
I always put a lot less, and that is my own safety level. Because if I am so anxious, then I will end up making dumb decisions and I will lose money. So my approach works for me. And then why every month I have action versus Contra Turtle who only acts in periods of great pessimism is because I cannot stand sitting in cash. Yeah, and I boleh tahan the 2% yield on
There's a capital
SBs
drag
and
on
stuff.
that anyway.
Yeah, I hate
Yeah,
the
cash
cash drag.
drag. Yeah.
And also like he talked about not wanting to, like for him it's not about beating the markets, but I hold myself to a different standard. Every year I ask myself, have I beaten the S&P? Have I beaten the average investor who just DCA into S&P? And I hope that every year the answer will be yes. Obviously in 2022 it wasn't. Yeah, so I think like listeners, if this is your first foray into investing, this just gives you 3 schools of thought, but more important that you find your own.
Yeah, and we exclude the DCA, broadly diversified, because that one don't need another person to
That
say.
one don't need to teach lah.
don't-
Yeah, just learn for free online.
It's already there, right? So if that's that, great. Okay, so maybe on that note, right, I do want to push a little bit before we go into like 2026 and all that. So you see, right, the World Wide Web has its beauty and has its problems, right? So somebody may come in and listen to you, and it's like, oh yeah, budget pay makes sense. Then after that, click, got referred to, like Chris, right? And it's like, oh, Chris also makes sense, and then somehow figure contractor, say this also makes sense. So then sometimes the question will come and they end up with this like mixed portfolio type of situation, which is like, I don't know, any take on that, right?
I mean,
like how
I
would
can
you
share my own
share your
experience because I
perspective?
started off like that. I learned from so many different schools of thought, right? I went for 5% courses, which was very at first value investing, then they started to move towards value growth. And then now also a lot more growth and AI that has been added in. Then I also went for Dr. Ralph where they thought about FA and TA. And
Right.
TA a lot in Dr. Ralph
Yes,
versus
it's
at 5%.
not me, but yes.
Yeah, TA is a lot, right? And then I
Right.
also went for options courses. I have spent so much time and money on different courses. And of course, when you learn from these different trainers, you will get very enticed because obviously these people succeeded and you want to succeed like them, right? And you are learning the formula that they use to succeed. So it's very enticing. But what happened was that I think, so in the beginning, in my 20s, I started with a very japalang portfolio because I was like, at first, right, I started with people say start with your circle of competence. So I started with just Singapore stocks. So then I started hearing that, then I met Chris and his blog, right? And I was like, hey, this guy very inspiring, like dividends, passive income, can retire his family. So I was like, I also want next time. So I asked, I read more on his story. I was like, oh, I need to start building now because he started building aggressively in GFC also.
Yeah,
right?
actually in my second paycheck onwards.
Yeah,
right?
so it needs time. So then I was like, okay, then I'm
You
going
can
to
check
have
out their podcast. Yes, we had a great chat.
and I have an interview with him also, which has done very well. A lot of people very curious
yes,
about
you
it,
should
right?
do it again.
Yeah, so I then
Right.
created a dividends portfolio, a Singapore portfolio. And then after that, I was hearing like, hey, actually Hong Kong also very good. So I went into Hong Kong also. Like Hong Kong, China, big market, a lot of growth. Companies like Tencent are like, oh yeah, I love Tencent. Okay, so I look at it. And then after that, obviously COVID came and everyone was then US, right? And in the beginning, I didn't touch US because the exchange rate and all was a bit more complicated. And then in the end, the returns were so good that it doesn't matter how the exchange rate even fluctuates anymore. So it did not matter that I paid more to enter with the exchange back then versus what I'm getting now, okay, because the returns were just so much higher. So then I created a US portfolio. And then after doing that for I think about maybe say 6-7 years, I started to ask myself, this Japalang portfolio how? right? But I realized that I like it because at the same time, it fits me. I have also tried to open up like an option portfolio, right? And other different types. But I realized that it's very hard. Yeah, then some people say just do like ETF portfolio because I think in our era, quite a few bloggers in the end, they stopped.
They
right?
stopped, yes,
Yeah, they
entirely.
tried.
And then they
Correct.
went for the broadly diversified global ETFs.
Yeah, and they
which
kept
I
saying
respect,
that
which is
cannot beat,
fine.
right?
Yeah, I think it's great.
Correct.
Yeah.
So I tried that.
Yeah.
And then I was like, no, this is not for me.
Right.
So I think in the end, the key thing is about you can test and you take the beginning parts of your investing journey to try and experiment. But eventually, after doing it for a while, you will know what resonates more with you and you can change or restructure your portfolio. I'll also put it out here that I think, although again, this might change in the coming years, I don't know. But I do think that I'm going to reach a certain stage where I may convert and liquidate my entire portfolio to move only 100% to dividends like Chris, or maybe like have a 80% dividends and 20% itchy hands capital gains. I don't know. But I may restructure that eventually.
Well, I mean, for me, I don't see a problem with anybody having a Roja portfolio because these days, even if you look at Gen Z, their career choices in their lives, you have career portfolios as well. For some people, yes, your personality imprints into your portfolio and you just gotta somehow just live with it. I have read a book on this neurotransmitter, I think, dopamine, right? And we all have a different build-up, right, on how dopamine works in our body with serotonin and all the other chemical neurotransmitters. And there are different personalities. There are people like me who plan for the future 10 years in advance. But if you think about it, we have a serious weakness because we really don't know how to enjoy the present. It's been a consistent point in my life. Right? So if you want to be like me and you want to collect money from dividends, right? It may be because you have the same kind of chemical transmitters as me, right? And I'm not going to judge somebody that has a more YOLO-like kind of personality, and it works for them as well. And I think in my 50s, I've gone beyond telling people that you got to be like me, you got to live on your dividends from the age of 32 onwards, right? Yeah, it might be a little bit unfair for Gen Z to do that. And yeah,
It's just what it is.
it is what it is.
Okay.
I want to
fair.
ask Turtle, how
Right.
did you come and decide on your strategy? Because the truth is, I find it so hard to be so concentrated.
There are two things that I consider, or I always tell people, how do you decide between growth investing or income or dividend investing? The first one is definitely temperament. Are you someone who is able to emotionally stomach volatility? For example, like what happened in April last year, right? I think you also experienced it during Liberation Day. I think my portfolio went down like 20% in the span of within 2 weeks. But during that time when the portfolio went down, I slept like a baby. Like it doesn't affect me. I don't know why. Maybe it could be like what Chris just mentioned. It could be different neurotransmitter makeup. Like it just, for me, I look at the numbers. I'm very detached. I don't see if, let's say, my portfolio goes down 100K. I don't see it as, oh, I lost 100K, which I could have gone to Europe or somewhere for holiday. I don't, like, there's total detachment for me. I just look at the portfolio in terms of percentage terms. So if you're someone who cannot emotionally dissociate the value of the portfolio from your daily life and expenditure, then a very volatile growth sort of concentration approach is not suitable for you. And even with dividends, so that's the first thing, right? The temperament. Right, there's a whole bunch of different things. There's also like your resilience to FOMO. When people are rushing in, you gotta not go in. When people are scared, you have to go in. And then there's also like the fear that I just talked about, holding onto a position with conviction. So that's the first thing, temperament. The second thing is, I think, is about time horizon. On a total return basis, on average, it's not always true. I will talk about one exception, like in the local market. On average, the total return, given a long enough time horizon, usually growth stocks, assuming you find a good high quality ones, will outperform dividend stocks.
Yes, definitely.
On a total return basis.
Coming
No
from a dividend guy. Yeah.
Yes, no doubt about it. And I just want to build on what Contra Turtle has just said. It all depends on your neuroticism score. There are people who are exceptionally neurotic. They look at my dividend strategies. And REITs, we had that moment in 2020 March when it crashed, just as bad as Liberation Day, by the way. And I'm telling them that the drawdown is 45%. And they say, how can you consider this a safe strategy? I say it's safe if you do not believe that the pandemic is going to ever happen again. the first thing we need to do is obviously we need to quantify it and then we show it to people and they need to decide for themselves, given their temperament, their neuroticism, whether they can engage in that portfolio. And you cannot engage in that portfolio, then put your money into CPF. Right? Yeah, and I can totally respect that.
Is brought to you by
Not CPF.
Yeah.
It doesn't mean it's a bad thing.
It is a good thing, right?
Yeah.
And the good thing is that I think Contra Turtle has revealed to us that he's actually might be a little bit below the median on a neuroticism score, which is actually quite good. He make good husband material.
And also, like, I think some people assume that if you're young, you just go growth because it gets total return. In general, yes, but there are exceptions. So, like, even when you talk about like dividend investing, right? They just look at DBS. On a total return basis in the last few years, right? It's pretty much on par with a lot of big tech in the US if you consider capital gains and the dividends that you get. So, like, for some people that say that dividends, you cannot get gains that are comparable, it's actually not true. It's possible to get total return that is almost comparable.
Okay, let's be humble here. DBS is one of the counters that we
One of the
have.
counters, yeah.
Yeah, and I
Must
always
also
tell
acknowledge
people, let
DBS
us
is a
not
growth stock also,
fixate on DBS. The problem is that if we were to push DBS this way, there is a group of investors who will just say, why don't I just invest in nothing but DBS, right? And then you have to deal with the idiosyncratic risk of DBS, which includes things like in the special economic zone, DBS doesn't have a bank in Malaysia at the moment, but UOB and OCBC does, right? So, yes, we've done very well with DBS. I have a lot of DBS, but I just want to remind people that our nature is when we do well, we think that we might actually do badly the following year, and we try to keep our lives, as balanced as possible.
Hey, welcome to the Financial Coconut Podcast Network. I'm your host, Reggie, aka your Chief Financial Coconut. And if you're loving what we're creating here, like, share, subscribe, share with your loved ones, comment in the comment section below. And yeah, we'll see you for great content on Chills with TFC. Great. So I think this is a opportune time to talk about 2026, right? So like you were talking about economic zone, you were talking about Venezuela, we barely started, a week into 2026 and already things are happening, right? And the
Trump just
backdrop-
woke up in the new year and decided to choose violence.
Yeah. So there's that whole bit, and besides some of these things, and there are also factors that have kind of been growing over time, right? Whether is it the dollar, whether is it China, this all these bit AI, everything, right? So just want to open up the floor and hear your thoughts, like for 2026, what is your, wide view, and then, where are you going to look at? Yeah.
I have two answers. My first, as what I always tell everyone who DMs me asking this, is I'm not God. And there's a really good study out there that says even God cannot outperform the markets. I think that study was about
because
how...
God owns the market.
No. As in that study, which I'm sure you have read before, right? Quite a famous study. It showed that assuming there's an investor who has perfect timing and has knowledge of events and buys at the crash and sells right at the peak before it crashed, something like that, basically perfect timing. But even across the time frame that was studied, that investor couldn't beat the market. So I always say, I'm not God. What do you expect me to do? I cannot predict. Honestly, did anyone even predict that Trump was going to take over Venezuela on 3rd January? I don't think any
One guy
model...
on Poly Market did. One guy.
Yeah, one out of how many billion people in the world, right? So I don't bother with predictions. That's my first answer. But my second answer, I know because people are like, but I want to know some direction, right? So I'll give you a direction or where my opinion is. I do think that...
This is not financial advice.
Yeah, it's not financial advice. It's
so
opinion.
Don't laugh. You're showing too much chin already. Later people can tell who is it.
Yeah, so my opinion is that there are a lot of things in the US that are overvalued. And the valuations show that the historical valuations point to that. And there are a lot in Asian markets that are undervalued. I don't study every Asian market. I find it really hard to crack Korea and Japan. I wish I did. I would have made that huge gains that I talked about earlier, especially in Korea, right? But I cannot overcome the fact that if I cannot understand the language, I am banking on the fact that the translation is correct. Yeah, and then when I dig first-hand information, it's going to be in the local language, which I cannot accept. So my nature, or in your words, that neurotic part of me, I cannot do this style of investing. But I do think that Asia has a lot more undervalued stocks. And that's the reason why a lot of Asian counters have have performed very well in 2025. And I think we'll continue to see more of that in the coming years because valuations wise, they are really just cheaper. Yeah, if we look at, let's say, even SGX, there are a lot of counters that are similar to certain of their US peers, but are trading at such a low valuation that are like, hello, can you move up? Can you at least go up a little bit more closer to your US peer? Yeah, but I think this is where the opportunity will lie. And China especially, I feel, is super misunderstood. A lot of people are so scared because of the 2022 issue, cease crackdown. But honestly, the growth in China is there. You just need to be looking at the right ones and entering at the right prices. So that is my view of not just 2026, but moving forward in the coming years.
So for me, when you look at the Singapore markets, our price to earnings ratio is going to be slightly north of 14 PE, right? I believe that there's still more upside to go. Now, nevertheless, I do not believe that the 2025 record can be beaten. So I expect the STI to be up a little as compared to being up a lot. All right. So that's my prediction for Singapore. Now,
What is a little? So in 2025, it was 22.
Single digit gains. Okay. DBS believes that it will end at 4,880. I think it will slightly exceed that number. Okay. Now, do understand that I do have my personal bias, and one of my personal bias is that I currently believe in DBS's report that the STI will hit 10,000 in 2040. I'm
On
a
what
believer.
basis?
On the basis that I've simply read their working. It's like when you read a math report, a lot of people fixate on the answer, which is 10,000 by 2040. I read the working and I felt that the working makes more sense to me.
So what's the working? Can you share your...
The working is a little bit complicated. They use a ratio known as market cap divided by M2, which is market supply. And they expect markets to have an average number of like 1.1. And Singapore, when the report was published, it was 0.8. So they derived it, I think, based on that ratio. I mean, they could be wrong, but having seen the working, I felt that we
There
can
is
go with
basis
it.
lah.
There is some basis for it. You're not pulling a number out of thin air, right? Of course, you can question why they've chosen that ratio. I don't have access to the DBS economists. So currently, I believe in it. Right. Maybe one day we'll have a good chat with them. Right. Okay. For the international markets, because I use a lot of programming code to get some insights, so I might have maybe a stronger grasp as to what's happening in the markets right now. My momentum indicators tell me that the 5 areas that are experiencing strong momentum moving into 2026, very objectively, it is gold, nickel, and lithium, followed by the Vietnamese stock market, as well as the defense counters. The defense counters, amazingly, on the 1st of January, the Venezuela thing hasn't happened yet. So that particular portfolio that we've built has done very well over the past 3 to 5 days. As for whether the American stock markets, especially on AI, Contra Turtle, just don't be offended. I'm a little bit contrarian from you. I somehow believe that the AI bubble might pop in 2026. And even if it doesn't pop,
We might be aligned.
right. We might be aligned.
Yeah.
Okay. If the AI bubble pops in 2026, where do we want to be? Yeah, we need to answer that question. Even if it doesn't make any changes in your portfolio, we need to answer that. And at the moment, I think the commodities bets that are making into the defense industries as well as Vietnam, I think they're fairly sound investment decisions. Yeah, and of course, you can always put some money into bonds, but bonds wouldn't do that well because the bulk of interest rate reductions has sort of peaked. But then again, we might have a new Fed chair, I think sometime in April. Yeah, but don't try to predict macroeconomic policies because you're going to fail.
I mean, I don't know if the bubble will pop this year or like when I say this, I know there are people that follow me. I'm going to get hunted down by the Nvidia people already. But I think that this year is really important for a few reasons. We have 3 really important IPOs this year. One is SpaceX, of course, potentially with Elon Musk. The other 2 is Anthropic and OpenAI have already, they are in talks to do IPO possibly in the second half of 2026. And why is it so crucial? Because once you do IPO, right, the revenue and profit numbers will all come out transparently. Right now, all we are getting is just bits and pieces from like publications like The Information or like people making conjectures on FinTweet, etc. There's no really clear idea of exactly what kind of margin profile all of these AI companies are earning on their revenues. My take is very low because the cost to serve inference, technical way to explain, like when you're serving, like when you type to LLMs like ChatGPT and you get an answer, that's inference. But the cost to serve inference is way higher than something traditionally like Google search, which is way lower. And one interesting thing is that people don't realize this, but I know Google has been a great performer last year. In fact, they were the biggest performer amongst the Mac 7. They grew like 65%. That's like the top performer in the Mac 7. One thing that's really worrying as we go into 2026 that I'm looking at very carefully is the amount of capex. Compared to pre-2022, right? Currently, Google's capex, right, has actually already, they are deploying more capex in their net. Before the whole advent of ChatGPT came out, right, before 2022, right, Google's capex, right, per year, right, it was only 25% on net. But today, right, the capex is more than their net profit. That is actually quite worrying. Now, I know there are people that say that, there's this whole thing where you need ROI, there's time that you need for all these AI investments into chips, into infrastructure and data center. You need time for all these things to play out. And then AI is such a monumentally life-changing thing for human civilization across the world that it's worth waiting for that. My slight pushback to that is that since GPT was released in November 2022, it's been coming to 4 years this year already. And so with the IPO, when the numbers come out, right, and given the fact that it's been 4 years, right, I think the honeymoon phase of the proof of concept of whether or not AI can return a sustainable ROI for all the level of data center investments, right, it has to be done this year. And, three people have said the same thing. Sam Altman, Satya Nadella, Microsoft CEO, as well as even Meta's Alexander Wang, who is the head of the AI division. They all say that currently AI models are experiencing what we call model overhang, which means that at the current moment, right, all these AI models, right, they are way more advanced than what people are actually using them for. And so this year, right, is the year of utility. We have to see really like big enterprise use cases coming up rather than your usual chatbot, your customer service, your internal search that enterprises use. I need to see more. Right, so this year, I'm really skeptical, like going to this year, because I still don't see the enterprise use cases. There's enough, at least from my vantage point and my workplace, to see that the ROI is coming in. So I think this year is really crucial to examine that.
Okay, great. I don't have a great counterpoint to that, but I love it. I love the lay of the land, right? Like we have laid out some very, very interesting stuff. So pretty cool. Maybe, to round up the discussion for today, based on what you have shared, right? Because you've shared individually, you've shared your investment core strategy, you've shared your outlook for 2026. Maybe to push it one more step further, how are you positioning or repositioning your portfolio then? Even if you're not changing, that's also a great tone. Yeah. So
if I look at how I've invested for the last, say, 5 to 6 years, the truth is I haven't really changed a lot of what I do. Because this year, I was able to use AI to do a lot more research and cut down my time pouring through documents. So that gives me more time to do other types of research that AI may not necessarily be able to pull out for
like
me.
what?
Making judgment call, analyzing management, reading earning call transcripts and discerning the character of management, their growth plans, how they're answering analyst questions, stuff like that AI can't
How
really
do you
tell
kind of,
you.
maybe just on that, right? Just give me a bit of color. Like, how do you kind of judge?
I don't name specific examples, but I'll broadly share. So if you study enough and you read enough, you will tend to see some management tend to be quite avoidant. The way they avoid the analyst questions already is like a potential red flag, right? Like, why do you need to, like, 拐弯抹角,
Okay.
that kind of thing.
So to you that is a minus point?
Yeah, to me, I'm like, no. And I don't like management that play down their failures. I prefer management who acknowledges that they made a mistake and what was the learning point that they got from it and what they will do to prevent that from happening again, rather than just pretending it did not exist. I'm not really changing much. My strategy remains the same. It is more of how can I continue to do what I do while pushing the returns more, and I want to try and reduce the action. I think once a month is a decent amount, but when I reviewed 2025, I was a bit shocked that I fired so many bullets in April. Now it looks like Warren Buffett had that punch card, right? Then this is where like Contra Turtle will score A++ for because he only punched 5 times. But like last year I punched so many times, of which like I think 30% of the time was all done only in April. And I'm like, oh my God, I didn't even realize I made so many moves
But it's
last year.
consistent to your investment strategy.
Consistent to my strategy, yeah. But I want to also try and figure out like, one thing that I'm coming to now is the monitoring. Yeah, so I actually asked Chris on how he monitors last time lah. Okay, and I'll let him answer that later. But for me, I'm starting to find that I have too many and I want to spend more time monitoring some of the ones I have so I can hopefully also be a bit more contrarian like him and have bigger size positions and conviction because I'm unable to step out of at any one time when I fire a shot, it has to be single digit. Right? Can I potentially do what Munger did, which is you swing less but you hit bigger. But to get there, you require a lot more research, a lot more confidence, a lot more conviction, which are more psychological barriers that I need to overcome. So I think 2025, one thing I'm very thankful for was April was a very good test because the fact that I could deploy 100K in a matter of 3 days shocked myself. If you had told me that there would be a time where I would deploy 100K in 3 days, I'll say you're mad. But April presented the opportunity and I acted swiftly and I'm glad I did because I did not do that in COVID. Because when COVID crashed in March, I kept thinking, this is not the end yet. The pandemic and lockdown is only just starting. I think there'll be more downside to go. But the rebound then was so fast that I was like, I should have dropped everything and like really just deployed more at that moment. And then let my additional income and capital be deployed subsequently. This year, when that same chance happened in April, I learned from my COVID mistake. Right away, I deployed like about 80-90% already.
I'm going to channel another financial influencer that I shall not name. He asked a very important question to the investment community and he asked, are you a gundu or guru? The obvious answer for many investors is, I want to be the guru, I want to make the alpha, I want to achieve these kind of gains, right? But as I look at my investment performance for the past 6 years, I have been a gundu maybe 3 to 4 times just to become maybe a guru for 2025. And even then, we underperformed because we were heavy on REITs and the people who focused on DBS obviously made more money. Why do we always want to focus on being smarter than other people, getting better than alpha than another person, when you can just fail forward by collecting 5 to 6% dividends and focusing on other areas in your life that demand your attention? So recently, today, Budget Babe asked me a question in our chat group. It concerns a company called Infinity Holdings, right? Infinity Global. And Budget Babe said, have you done your study on the stock? I said, Budget Babe, I've invested $1,000. I have not done any study on the stock other than your ramblings and the group discussion that claims a 7.8% dividend. And he said, so what are you going to do next? I said, I'm likely going to increase it to 10,000 for my position. Are you going to study the stock? I said, no. I said, I'm going to get $10,000 into that counter. I will receive a dividend in February. And using that money, I might get the motivation to study the stock. At the end of the day, we are like an LLM. You know, we need to use a lot of energy to infer something, right? But at the end of the day, people say that ignorance is bliss. Choose bliss. Collect 5 to 6%, you know, have as little drama in your life as possible. I'm 51 years old. I obviously cannot be as hard driving and successful and hustle as much as the other 2 panelists today. And I think that there is a certain value in that. And if it comes with a certain underperformance, you know, that is the nature of life.
Okay, so why isn't Bliss the broadly diversified portfolio?
It is. Bliss is indeed what we are trying to gun for, right? 60 to 70 counters, that is an absolute mess, producing 5 to 6% every year with a beta of about 0.8. So we have 20% lower risk than everybody else. Yes, there is a tendency to underperform. But the fact of the matter is, if you talk to a lot of high net worth individuals and you mingle with these people, multi-millionaires, that's all they want. And the funny thing is, I have people who are really high-flying professionals in their younger years, in their 50s and 60s. And they say, Chris, what I really need is something that you do for your mom. You invest your money for 5 to 6%. I don't need any capital gain. I just want a son like this. I said, well, I can train your son, you know? Yeah, but that is basically the difference between someone who's really wealthy and someone who is what sociologist Pierre Bourdieu, right? He calls them the petite bourgeoisie. And the petty bourgeoisie, in my view, will always be chasing alpha. High social and cultural capital, you will need to reach a point where you stop fixating on the alpha and you start fixating on the yield.
Can I also add on your point on bliss? I think bliss is also something I've learned over the years. It is what you're comparing it to. It is all relative, right? So bliss can be just DCA into a global diversified index if you don't look at the person who's doing better than you because they chose a different strategy. But if you look at, let's say, the two of us portfolio, and you're like, I want the kind of returns that they have, then you're not going to feel happy about that strategy. Right. And then on the other hand, I think what is very admirable about Chris is that he's very happy with his strategy, but we have acknowledged that it's not going to work for us. It's not going to make us happy.
Yeah, but I respect what you guys do as well, because people in different stage of life, they might want to see higher alpha. Your life circumstances change, and you will change with your portfolio as well.
Yeah. So it's what we focus on.
Yeah, and we got to respect
matters.
that. We got to respect that there are many ways to get where you want to be. Don't fixate so much on a person's portfolio or his pronunciation.
Enough! Okay. Maybe last one for Contra, because you did lay the ground that okay, you have a highly concentrated portfolio of 5 stocks, but then you kind of profess some changes, at least in the start of the podcast. So just so I get it out, what is your position, or how do you plan to adjust in 2026?
Yeah, I think in 2025, I actually only made 10 transactions. They were all fat pitches. The majority of them were all done in April during Liberation Day. Going to 2026, just a gut feeling, right? Because I cannot predict the bottom or cannot predict the short-term future, right? Even this year, right? There's a saying, right? Man who pick bottom gets smelly finger, right? Have you guys got the feeling? The saying is right?
I love that.
Yeah. I think was it Adam Khoo or someone said this. I don't know. It's just been
there
in my
are
head.
too many social media shots in this episode. But yes, please.
Yeah, so man who pick bottom gets many fingers. So I can't tell you what price level the S&P is going to go or where the positions I hold, or even those on my watch list are going to go this year. But one thing my gut tells me is that this year I will likely increase my cash position, number one. I will likely be performing less transactions. But in the words of Peter Lynch, I think there's more money that has been lost in anticipating a market crash than has been made. That is one thing that I always maintain that philosophy. And because of that, I don't see myself selling positions. I don't consider that at all, in fact, in the next decade. Because each one of my positions, in the very first place when I deployed money into it, my thesis is not a 1 or 2 year thesis. It's at least a 10-year thesis. I have about at least 12 more years to go. So for me, whether or not 2026 things will change, I will remain in my positions. But that's the Peter Lynch side of things. Now there's another really lesser known investor. Right? His name is I think it's called John. It's pronounced French. It's Jean-Marie Yavat. There is this very popular book amongst investors I highly recommend. It's called Richer, Wiser, Poorer. It's written by a financial journalist called, is it William Green or something? There was one story he talked about 3 years, right, leading up to the Nasdaq bubble bursting in .com in 2000, right, where this investor, right, this French guy, John Marie, right, he was like one of the most hated investors because he doubted the .com boom at that time. Everybody was investing in like companies like Cisco, etc. at that time, right? And because of that, he underperformed the market by 3 to 4 years. And they were very, very painful years. But he kept to his discipline all the way. And when the .com bubble finally collapsed, for the next 3 years after the .com bubble collapsed, his fund, which is the First Eagle Fund, outperformed everybody in the market. So sometimes it's really about, a balance between these two philosophies. On one hand, we have Peter Lynch that says more money has been lost while anticipating a market crash. On the other hand, I think it's also good to be cautiously optimistic as the AI cycle is going on. So this year, in summary, I will likely increase my cash position. I will likely reduce the number of transactions I perform because I'm seeing a bit too much FOMO. And I will just wait and see certain signs I'm looking out for with the whole AI narrative.
Fair. Although I still find it very cute looking at the...
I don't know where to look.
The turtle mask is okay. Like this guy is saying some, interesting things, but I find it very hard to take him seriously. The turtle mask, but that will be consistent until one day when he decides to review, and you review on the platform, right? Here.
Okay.
Committed to that. Okay, so yes, thank you all for your time. Appreciate, and I hope you at home enjoyed today's episode. Some perpetual strategies around how some of these investors are managing their money, and also how 2026 potentially will look like. So as with all prophecy, at the end next year you will take this episode, come out and score off them, right? So
I welcome that.
It's okay. We can look wrong for a few years, but then become right later on.
Fair. So let's keep this thing running for a few more years, and then we'll see where this comes along. I hope you enjoyed today's episode, and if you want to stay updated, as you can tell, we are trying to shake things up. Go to thefinancialcoconut.com to put your email so that we can get in touch with you and route out the algorithm when we need to. Hope to see you at our next event and for our new content launches. So with that, that's all for today. We'll see you next episode of Chills with TFC. Bye-bye.